This is going to be a longer market update today because there's a lot to talk about. And I want you walking into 2026 actually understanding what's going on, not just reading scary headlines. So grab a coffee, get comfy, and let's get into it. You've probably heard this already, but 2025 was the year of the snake, a year of shedding, releasing, and clearing out everything that wasn't meant to continue forward. And honestly, that feels exactly like what this year has been. A lot of people felt squeezed financially. A lot of plans didn't pan out the way we hoped for. Interest rates, uncertainty, an election, layoffs, teacher strike, market adjustments. It was a year that forced a lot of us to reset. But 2026 is the year of the dragon, which symbolizes rebirth, rebuilding, and forward momentum. And everything I'm seeing in Calgary's real estate market lines up with that energy. We're shedding the old cycle and we're stepping into a new one. And if you stick with me through this longer update, I'm going to show you exactly why I think Calgary is setting up for a year of renewal, opportunity, and growth, even if the journey isn't perfectly smooth. Now, let's start with the question I'm getting the most. Are we at the bottom yet? And my honest answer, I think we're getting close. Not for every segment. Apartment condos are still sitting at record high supply levels, record high active listings, and with thousands of new purpose-built rentals about to hit the market. Plus, CMHC MLI Select projects are entering the pipeline. Renters have options, which puts downward pressure on rents, and when rents soften, investors pull back from buying condos, which adds even more pressure on prices. So apartments are not done adjusting. Prices will likely continue sliding unless there's a major shift in demand. But detached homes, duplexes, those feel like they've pretty much found their floor. Townhouses are a bit different. Calgary is still oversupplied there, and most of the townhouses that exist are either too small, full of stairs, or both. They just don't meet the needs of the two groups that want them the most, young families and downsizers. But the townhouses that feel like a detached home, fewer stairs, double attached garages, more generous square footage, those remain incredibly attractive, especially for people who want the feel of a larger detached home without the price tag. It's wild because 2 years ago, townhouses were the hottest thing in the city. Everything was going into bidding wars. And now buyers have choices again. And that takes me to my next big point. There's something happening in the market that the stats don't fully show, but every realtor can feel: consumer confidence. And I'm going to be careful here because I don't want to plant fear where people weren't already feeling it. So here's the truth in the most grounding way possible. People are more cautious right now. They're not sure how they feel about the economy or interest rates or job security. So instead of jumping, they hesitate. That doesn't mean there's no demand. It means people are slower and more intentional. They're methodical. They need the price and the product to actually make sense. Not pandemic sense, not FOMO sense, but real rational sense. This past month of November was honestly slow for me. My clients weren't panicked. They were just unimpressed with what they were seeing. They're ready to buy. They're pre-approved. They're watching the market daily, but the homes they're touring aren't exciting them. They aren't feeling that spark. And when they do find a home that they like, we're seeing situations where sellers' bottom line and the buyer's bottom line are simply too far apart. Deals are taking longer, some are falling apart, inspections are coming back with long laundry lists longer than a Costco receipt. I've even seen mortgage brokers drop the ball. There's friction on both sides. But that's not a sign of collapse. That's what a transitioning market looks like. If this is the type of content you've been looking for, please show your support and don't forget to like, share, and subscribe. Let's talk numbers for November so you have some perspective. Calgary saw a little over 6,400 active listings and about 3.6 months of supply. Detached homes average around the mid 740,000, duplexes in the mid 680s, townhouses in the low 430s, and apartments around the low 320s. Detached and duplex prices stayed fairly stable. Townhouses softened and apartments softened even more. But there is an important nuance here. Not all detached homes are equal. Detached homes in established communities, the ones closer to the core, with trees, schools, character, those remain strong. They hold value even in slower markets because they're desirable, they're finite, and proven. Detached homes in the far edges of the city, brand new areas competing with brand new builds and builder incentives, those markets behave differently. Builders can throw in appliance credits, landscaping, upgrades, rate buy downs, and homeowners can't compete with that. So sellers in newer outskirts communities are competing with brand new product every single day, and it's a tougher environment. Now, here's something you need to understand on a deeper level: the missing middle problem and why people feel stuck. Imagine a young couple who wants to buy their first home, but the prices jumped over the last 4 years faster than their income, so they can't get in. Now, imagine a move-up buyer who wants to sell their starter home, but the 30-year-old who would normally buy it can't qualify, so they can't move up. Now, imagine a 70-year-old couple living in a 4-bedroom house who'd love to downsize, but there's nothing in their community, because one thing we need to realize is some seniors want to stay in the communities where their children grew up. They just need to find something that fits their need. But everything they're seeing is either too small, too many stairs, or too expensive, so they can't move either. When first-time buyers can't buy, move-up buyers can't move, and downsizers can't downsize, everything gets stuck. That's the missing middle. And we are not building enough of it. We're building lots of apartments, tons of rentals, but not enough duplexes, not enough larger townhouses that actually function like homes people can age in and raise families in. Not enough ground-oriented product that supports movement in the market, which is why resale is so important and why established communities with real homes, not just units, continue to be the backbone of Calgary's market. And while I'm talking about broader context, let's zoom out and talk about why Calgary still looks incredibly strong long-term. Calgary added about 100,000 new residents this year alone. That's an entire mid-sized city dropped into Calgary in a period of 12 months. And that's on top of the migration boom that we had in the 2 years before that. Alberta is the youngest province, and we're still the #1 destination for interprovincial migration, especially for families with kids, which is why our schools, teachers, and job markets are still trying to catch up. We've just experienced growing pains. Alberta's unemployment rate is higher than the national average right now, but it's not because the economy is weak. It's because we have so many new people arriving so quickly that the job market needs time to absorb them. Mark Parsons broke this down perfectly at the Calgary Economic Outlook event that I attended earlier this November. Alberta has recession-like unemployment without the recession. It's a population shock, not an economic crash. And even with that, Alberta continues to outperform most provinces on population growth, construction activity, energy exports, aviation, tech, and logistics. Tech employment is up over 60% since 2021. Venture capital investments just placed Calgary ahead of Vancouver. Aviation and aerospace are booming. Life sciences are scaling, and energy, despite being the backbone, is no longer the only engine. Now let's talk politics, because like it or not, it shapes our housing market. In November, we saw a landmark energy agreement between Alberta and Ottawa, something we genuinely haven't seen in years. The goal is simple: unlock private investment, cut back red tape, and finally get Canadian energy to overseas markets instead of relying almost entirely on the US. Premier Danielle Smith also announced that Alberta will act as the proponent of a new West Coast pipeline that has committed $14 million to early planning, with Indigenous partners included from day one. Whether you love politics or not, here's why this matters for your home's value: confidence. Energy confidence equals job confidence. Job confidence equals migration confidence. Migration confidence equals long-term housing demand. We also saw big moves with Alberta Health Services transitioning into a new provincial health agencies under Give Life Alberta. For families moving here, the message is simple: stability in health matters. When newcomers believe the system is improving, they stay, they buy, they put down roots here. This stuff influences real estate more than people realize. Now, let's get into interest rates, because this is where the conversation shifts dramatically. The Bank of Canada held at 2.25 after 2 rate cuts in the fall, and bond markets are pricing almost no rate cuts for 2026. And weirdly, that's actually good news, because now buyers aren't sitting around waiting for rates to drop. They know that this is probably where rates will stay, and Canadians famously love fixed rates. People don't want to lock into a 5-year fixed if they think rates will drop again. But now that we know we're basically at the floor, stability brings confidence. And fixed rates in the low 3s, that's normal, that's sustainable, that's healthy. So what does all this mean if you're buying or selling in 2026? For buyers, this is your leverage window. Right now, between December and middle of January, you have the advantage. Some sellers want things wrapped up before year end. New year, new me, fresh start. Some listings have been sitting. Some sellers will never say they're tired, but they are. If you can close quickly and give the sellers the conditions they want, possession, big down payment, you can negotiate. But once January hits, everything can suddenly change. Here's what always happens. Sellers take homes off in December so that they can host family and enjoy the holidays. Inventory drops. Then January 1st hits. Kids eventually go back to school, they get back into a routine, and people feel renewed, and the market catches fire almost overnight, showing surge, competition grows, and options tighten. If you wait too long, it can bite you. For sellers, this is your strategic moment. Not to list, we're too late into the holiday season for that, but if you're already on the market, this or next week are when a meaningful price adjustment can happen. After next week, everything gets lost in the holiday spirit. If you're planning to list in 2026, late January is your friend. The market wakes up. Buyers get their pre-approvals and momentum starts building right up until the spring. And remember, good homes that are priced right and marked well always stand out no matter the season. And yes, with my team, your listing gets marketing daily, even in the slower months. That's exactly why I hired a full-time marketing manager, because consistency wins in markets like this. So where does that leave us heading into 2026? We're not crashing, we're not collapsing, we're transitioning. We are moving from a year of shedding into a year of rebirth. Detached and duplex homes feel close to the bottom. Townhouses need the right product to shine, but the good ones do. Apartments still have room to fall. Builders are competing hard in the outer communities, but established neighborhoods remain resilient. Migration is strong, investment is strong, energy is stabilizing, tech is scaling, and Calgary